There's a particular moment that happens quietly, often without drama. Nothing goes wrong in an obvious way. No alarms, no letters marked urgent. It usually happens in the middle of an ordinary decision. Someone fills out an online form, they click Submit. They wait a few seconds longer than expected. And then the answer arrives. Not a rejection, just different terms. A higher deposit, a higher interest rate, a smaller limit. Nothing that feels dramatic enough to complain about, nothing that feels unfair in a way that can be argued, just a quiet reminder that something unseen has already decided part of the outcome. Most people don't think about credit scores very often. They're not discussed at dinner, they're not part of daily conversation at work. They don't feel like a reflection of character or effort. They exist somewhere in the background, abstract and technical. A number most people only check when something goes wrong. And yet, over time, that number quietly shapes what is easy and what is difficult, what costs a little more, what requires extra paperwork, what needs reassurance or guarantees. It influences where someone can live, how much flexibility they have during a job change, how expensive a mistake becomes when life inevitably shifts. Not dramatically, not all at once, but slowly and consistently. This is not about reckless spending or obvious financial mistakes. It's about how a system, designed to measure risk, ends up shaping everyday life in ways that feel personal, even when they're not. And to understand how that happens, it helps to follow one ordinary household through an ordinary life. The household is unremarkable by design. One adult, early 30s, a steady job, a reliable paycheck. After taxes, the monthly income lands around $3,800 in the US, or roughly 3,200 euros in parts of Western Europe. Enough to feel stable, not enough to feel relaxed. Rent takes the first and largest bite, about $1,450 for a modest apartment near a city center or commuter rail line. Not luxurious, not uncomfortable. Utilities add another $180. Electricity, heating, internet, all predictable. Transportation depends on geography. A car payment of $320, insurance at $110, fuel averaging $140, or a monthly transit pass closer to $160. Student loans still exist in the background, not overwhelming, but persistent. $260 a month, automatically withdrawn. Then come the quieter costs, a phone plan, a few streaming subscriptions, occasional takeout after long workdays, a short trip once or twice a year to visit family or escape routine. None of it feels excessive. In fact, much of it feels restrained. There is a credit card, used mostly for convenience. Groceries, online purchases, unexpected expenses that don't fit neatly into a single month. The balance goes up and down, not maxed out, not always paid in full. Life continues at this steady pace. Bills are paid on time, there are no collection notices, no financial emergencies, just little pressures that never fully disappear. From the outside, this looks like success, responsible, stable, and in many ways it is. But beneath the surface, something is quietly accumulating, not debt in the dramatic sense, but financial friction. A system reacting, slowly and continuously, to patterns rather than intentions. Credit scoring systems were built to answer a narrow question. How likely is this person to repay borrowed money on time? They are not designed to measure effort, or intelligence, or long-term responsibility. They observe behavior and reduce it to probabilities. Small patterns matter more than people realize. How often balances are carried, how close accounts come to their limits, how long credit histories stretch back. Even when bills are paid on time, the system notices utilization. It notices stability. It notices pauses and changes. The household does not feel risky, but the system does not see context. It doesn't see job security or health or family support. It sees ratios. When rent rises but income stays flat, credit usage quietly increases. When a surprise expense hits, balances linger a little longer. When a card is paid down and then used again, the cycle repeats. Nothing here is irresponsible, But over time, the credit profile stops improving and sometimes slowly declines. This is where stagnation sets in. Doing everything right still produces higher costs. Interest rates creep up instead of down, limits remain tight, and because nothing breaks, nothing feels urgent. The system rewards surplus, extra cash, extra time. Without those, it doesn't punish, it just withholds advantages. Consider the credit card balance. It averages around $4,200. The interest rate is 21%. Not extreme, not rare. That's roughly $73 a month in interest when the balance stays steady, about $875 a year. Over 10 years, that becomes $8,700. Not all at once, quietly, almost invisibly. Now imagine applying for a car loan. With a stronger credit score, the rate might be 4%. With a weaker one, 7%. On a $22,000 car over 5 years, that difference is roughly $1,700. Add a rental application that requires an extra month's deposit, another $1,400 temporarily locked away. None of these costs ruin the household, but together they remove flexibility. They consume margin. Money that could have absorbed stress instead disappears into higher prices for the same life. This isn't about ignorance or denial. It's about normalization. Everyone around the household lives similarly. Balances exist, rates are shrugged off, terms are accepted without discussion. Social comparison works quietly, not through envy, but through reassurance. If this is normal, it must be fine. There's also identity. Being responsible means paying bills, showing up to work, not missing payments. Credit scores don't align neatly with that identity. They feel abstract, detached from effort. So attention goes elsewhere, to visible progress, career steps, lifestyle stability, daily life. The system runs in the background. Nothing collapses, but options narrow. Job changes become riskier. Moves require more savings. Unexpected events cost more to absorb. Life remains stable, but dependent. Dependent on consistent income, dependent on predictable expenses. There is less room to pause, less room to choose. Not failure, just constraint. Financially calm people don't feel smarter. They feel quieter. They think in terms of margin, not returns. They value time more than optimization, optionality more than appearance. They understand that reducing friction matters as much as increasing income. Credit to them is not leverage, it's insurance against urgency. This isn't about tactics, it's about framing, seeing money as a buffer, not a scorecard. Credit scores rarely announce their influence. They whisper. They shape terms, not outcomes, costs, not identity. Understanding that system doesn't require fear or urgency, just clarity. This video is not financial advice. It's a description of how a quiet system operates around ordinary lives, and sometimes simply seeing the structure reduces the anxiety it creates. If this helped clarify things, consider subscribing.